Groww started in 2016 and they played the VC game to perfection. They raised over $700 million, hired thousands of employees, spent aggressively on marketing, and they recently had a massive IPO where they were valued at over $7 billion. Even at IPO, the founders collectively owned 27% of the business. That's generational wealth. But here's the story of another company in this space, Zerodha. Started in 2010 by the Kamath brothers, they raised a total of 0 rupees, grew profitably, and now have over 22,000 crores in the bank. And the family owns 100% of the business. There's one path that led to a massive IPO a lot faster. The other path led to total freedom and thousands of crores in annual profit. Two giants, two amazing outcomes, two completely different games. My name is Rohith Salim, and I've built both venture-backed startups and tried to bootstrap companies. My most recent company raised over $54 million in their Series B. I'm making this video to make sure you, the founder or the would-be founder out there, understand the pros and cons of bootstrapping a business versus going down the VC route. I want to make sure you make an informed decision on which game you actually want to play. Do I think VC money is evil? Absolutely not. In fact, for some of you watching, you probably can't bootstrap your business. But here's the downside of raising venture capital. The first big con is that you now have a boss who has veto rights on certain things. Want to pivot the business? They can say no. Want to sell the company? They could say no. Want to stay niche and profitable? They might fire you and hire another CEO who wants to blitzscale instead. When you sign that term sheet, you're the pilot, but they may own the plane. The scariest example of losing control is Dunzo, which was the startup darling back in the day. After pioneering the hyperlocal delivery model back in 2016, they gave Reliance 25.8% of the company. But along with the equity, the deal also gave Reliance veto rights over major decisions. And when Dunzo desperately needed to raise more money to compete with Zepto and Swiggy, Reliance used that veto to block the funding. Reliance essentially paralyzed the company from the inside out. The second biggest con of raising a bunch of capital is that you could end up spending all your time fundraising. I have a bunch of friends who are CEOs of various startups, and from speaking to them, they spend at least 50% of their time always planning their raise for the next round, even after you've just closed a round. This is time that you're taking away from working on your business. Now to talk about the next big con. When you raise venture capital or capital of any form really, you're closing certain doors for an exit. Here's some math that nobody shows you. Let's say you bootstrap the business and someone offers you 50 crores for your company. You can sell it, take the cash, and retire on a beach. That's life-changing money. At least it's life-changing money for me. But say you've raised 100 crores in funding, there's no way you can sell the business for 50 crores. Or even if you sell the business for 50 crores, your investors are going to be the ones that are going to take the first 50 crores out. In all likelihood, investors are going to block the sale because they're going to lose money. And even in those dire situations where the business has to sell, they're going to take their money out first, and nothing is going to get distributed to any of the founders. Every time you raise a round, you're actually raising the bar for your exit. There are thousands of companies that can buy your company for 50 crores. But there may be 5 companies in the world that can buy your company for 5,000 crores. Just think about that, because when you're raising money, you're making it statistically harder to ever win. All right, let's talk about the next big con when it comes to raising VC capital. VCs often kill good businesses. You might have a perfectly healthy business that grows around 30% year on year and makes a tidy profit for you and your co-founders and your team. But a 30% growth rate for a VC, that's just not really going to move the needle for them. So they pressure you to spend more money to chase growth. You end up hiring 50 new salespeople before the product and the overall infrastructure is ready for them. You enter markets you don't fully understand yet. You might think that you're moving fast, but the reality is that you're moving without any real direction. You burn through the cash and suddenly a good business collapses under the weight of its own valuation. That said though, raising VC capital is not all bad. You get a lot of credibility when you raise a round, and hiring becomes easier, and the really good VCs offer you insider intel that you can't find anywhere on Google. But you trade away your exit optionality, you risk killing a healthy business, and you also lose control. So is bootstrapping better? Well, it's not all sunshine and rainbows with this approach either. Here are some of the biggest cons. The first one is around hiring tier 1 talent. Really good engineers and sales leaders are expensive. They have families, mortgages, and market rate salary expectations. A VC-backed company can pay them top dollar from day one. As someone who's bootstrapping their business, you often can't match that cash component. You have to convince them to take a pay cut for your vision, and frankly, a lot of the top talent may just say no, and they may choose to work for a competing VC-backed business instead. The second big con of bootstrapping is that it's sometimes simply impossible. There are two scenarios where you just cannot bootstrap. The first is if you're in a winner-takes-all market and raising capital is going to be a big part of the game itself. If you try to bootstrap in this market while your competitor raises $100 million to subsidize and acquire users, you're just going to get wiped out. Take what happened to Andrew Wilkinson. He's an incredibly experienced founder, but he burned over $10 million of his own cash trying to bootstrap a productivity app called Flow. He was up against VC-backed giants like Asana and eventually lost over a 12-year period. Andrew later admitted that trying to compete without funding was like Fiji, which is this tiny little country, waging war on the United States. He didn't lose because his product was bad. He lost because he brought a knife to a gunfight. I'm putting a link to the full X thread in case you want to read the full story, because I read it and I was just like, holy crap, this sounds so painful. The second situation where you can't bootstrap is if you are in a very capital intensive industry like hardware, biotech, or even manufacturing. There really isn't a way to bootstrap in these industries. The third big con around bootstrapping a business is more applicable to younger founders who don't have much of a network and who require mentorship. When you raise from a top VC firm, you aren't just getting money, you're getting their Rolodex. They can introduce you to potential customers, partners, and even help you architect the sale of your business eventually. When you bootstrap, you're kind of on an island. You have to build every single relationship from scratch. I remember during the early days of Bootstrap, and we had raised capital at this point, but some of our earliest customers came from investor introductions. I doubt any of our early customers would have picked up a cold call from a no-name startup in HSR. The last big con is around speed. Bootstrapping is almost always slower. You're strictly constrained by your cash flow. You have to wait for money to hit the bank before you can make your next move. In a fast-moving world, that lag time can be painful. So that's the trade-off. Bootstrapping can give you a lot of discipline, focus, and you end up owning the entire business. But it's also going to cost you speed, feasibility in certain markets, and access to certain networks and talent. So how do you decide whether to raise VC capital or stay bootstrapped? You should bootstrap if you value autonomy, you want to build at your own pace, or you're still trying to figure out what your customers actually want. You can always choose to raise money later. You should raise venture capital though, if you're working on a deeply technical problem or in a land grab market where you have to move quickly at all costs, or if you need to buy the network and credibility that you don't currently have. Like I said, this is very true amongst young founders. But remember, if you do decide to raise capital from investors, The moment you sign that term sheet, the clock starts ticking. You're no longer building a business for yourself. You have a fiduciary duty to grow that asset for everyone who's backing you. If you do decide to raise, you need to know how to pitch and navigate a fundraise. In my next video, I'm walking through a framework you can follow to raise your first round of funding. If you want to see that, hit subscribe. I'm Rohith Salim, and see you in the next one.